So you've just launched a hedge fund amid this global pandemic, and it's been a difficult time for the industry. Bloomberg data shows that 3 out of 4 hedge funds lost money last month. So what approach are you taking in this environment?
Well, thank you, Selena. Thank you for having me. The approach is simple. I mean, if you think about the long-term tailwinds behind global internet value creation, there is no denying that there is just incredible opportunity ahead. Right. Our thesis is based on the fact that as you think over the next, 10, 20, 30 years, every piece of consumer spend and every piece of global business spend will have the look and feel of a mobile transactional internet. And so what you see is, even in a time like this, there are opportunities. In a time where global interest rates are at all-time low, investors, flee towards growth assets as a way to create yield and generate profits. So it has been difficult. I mean, look at how tech stocks have held up despite a pretty miserable overall GDP print globally. Should tell you a pretty good sense of how excited investors are. And, we certainly aim to take advantage of that overall tailwind.
A few weeks ago when we spoke, you told me that you're planning to hold on more cash and shorts until the S&P reaches 2,000. That's a pretty significant decline from levels right now. Is that still your approach? At what point are stocks accurately valuing this economic and corporate fallout?
Selena, it's really hard to predict a definition of the S&P. And I got to tell you that a few weeks ago when we spoke, the S&P was at 2,300. And if you think about how returns or S&P levels have trended in the last couple of downturns, the S&P gets to 7, 8, 9 times earnings for the current year. You got to juxtapose that with the fact that we've had unprecedented global monetary and fiscal stimulus. So multiples are just a function of rates. If you think about 2020, it's pretty clear to me that earnings are going to be down between 10 and 15% at least. And so my math is still very much the 2000 level, using a level for 2019 and then using a reasonable multiple that reflects current low interest rate environment. Now, it's clear that we've been wrong so far. We've had a ginormous rally over the last couple of weeks, but these kind of bear market rallies are pretty common in overall bear markets. And so I'm still holding on to a lot of cash. We're running the fund net short right now in order to deal with all this volatility. Again, I cannot tell you with confidence if 2,000 is a level that we will breach. But I do think that there is a pretty high possibility that between now and the end of the year, or frankly, even this quarter as earnings numbers come in, that the S&P is likely to take a step down from its current levels.
Ram, Rich in Hong Kong, tell me here, you say you've got a lot of cash. How much cash? What are you looking at particularly, given that you have this prediction that after all this is over with, the gig economy is going to explode?
Yeah, listen, we're very excited about companies like Uber. We're very excited about companies like Amazon. I expect there are a bunch of good private companies that have used this crisis to acquire customers for really cheap. So think about what's happening in the U.S., for example, with Instacart. The average cost of customer acquisition on Facebook and other channels have been between $30 and $50 historically for many of these on-demand economy gig companies. They've got a windfall because they've been able to acquire several million households effectively for free. These households, once they have tasted the convenience and the value factor of having groceries, for example, delivered in your house, it seems to have reason that consumers will not go back. And so what's going to happen is, I think this crisis has shown a few things about consumer behavior. One is people don't mind working from home. In fact, productivity is pretty high. CFOs, I think, will start mandating to save costs that people, who can work from home really work from home. And I think consumer behavior will move towards convenience, right? And so when you look at most of these gig economy companies, they've historically struggled with getting their CAC to LTVs the LTV to CAC equations to work. But if you think about low customer acquisitions organic consumer demand, people pull forward consumption. These are generally good trends for the gig economy. So if I look at the next few years, I would say things that we're very excited about are, companies like Amazon and Uber, which will keep taking share from offline ride sharing and offline retail. We do like companies that allow you to have snack entertainment. So, for example, in my previous life, I invested in both ByteDance and Facebook. I think those companies have got a long runway to grow. Today, Snapchat reported pretty incredible results despite a very weak ads market that tells you that people are sitting at home and there's a lot of productivity gains to be had hanging out at home. And I think any company that is able to capture incremental mind share of customers in their homes is going to benefit in the next few years. And if nothing else, I think what happens is their overall return on capital goes up because the cost of customer acquisition is just now better because people are looking for services that makes their life easier.
It's interesting when you're saying that working from home, Ram, may well be more and more common after all this, and that's as corporates, of course, try and conserve capital. And it's interesting, give us your experience, because you're not working from home, you're working from your friend's, your friend's home, are you not?
I certainly am, and part of it, and again, we got super lucky with that. The truth, though, is that listen, we are it's a headquarters, right? We are forced to work from a friend's home because we can't have an office. We're also pretty small. But I think the way I would think about this is I was thinking of having an office in downtown San Francisco, and the odds now, even me, is I might end up buying a house near where I live and walk 10 minutes to work. My point is more general. If you look at the Bay Area, if you look at New York, they have now become very expensive for the average white collar to live and work. If you think about innovation in the Bay Area, we meet hundreds of startups every year. And I got to tell you that one of the biggest concerns most managers have is how do you hire people and how do you pay them? And if you look at companies in the Bay Area, I'd say going back 2 to 3 years, there are 2 or 3 companies that have become all remote from the get-go. People commute an hour in America each way to work. And if they are equally productive, working from a remote location, they will, either for family reasons or for commute reasons or quality of life reasons or frankly for tax reasons. And so, again, I was having a discussion recently. Yeah, go ahead.
Ram, Selena here in Beijing. I just want to touch on that point. Speaking of the Bay Area, where you are based, there have been massive layoffs, startups shutting down. It's a tricky environment. Your fund also invests in private companies. So how do you expect Silicon Valley to come out of this? And what would you actually invest in? Yeah, it's a great question. It's really unfortunate to look at the number of layoffs happening all around us. I suspect that companies that were highly funded by VC capital historically, and now that capital raising and funding might be more difficult over the next 12 to 18 months, the first thing companies have had to do is cut real estate leases and then let people go. So we're seeing a lot of it all around us, and it's a tough environment, and I don't think it's accurately captured yet in unemployment stats. In terms of startups, again, at the end of it, innovation is bottom-up driven, and we think of stuff from a micro basis. Great companies will still be built. Great entrepreneurs will still be built, and they will solve big problems. And so, listen, what's eventually going to happen is companies will get very comfortable, I predict, in having a remotely located workforce from the get-go. I think it'll be a net positive for everybody. Companies will have their innovation sitting in the Bay Area, or frankly, we've invested all over the world. And in fact, Selena, if you looked at my tweet storm from a few days ago, we're taking a stand that innovation happens everywhere. So we will go wherever in the world to invest.